So let's talk about the oil markets today. So WTI crude price is at $53.74. Brent crude price is at $59.02 when I'm doing this live stream show. And if you look at a chart of WTI crude and Brent crude, they peaked on the 1-year chart in October of 2018, and they have had a couple rallies. They crashed at the lowest, it looks like, in January of 2019. The charts are following each other fairly closely. There's not a lot of divergence there in the charts between WTI and Brent. And the rallies, what I would say is the rallies don't look nearly as strong. It looks like it's making lower highs. So it looks like we are, especially after May and June of 2019, it looks like we're setting up for an even potentially larger oil price crash. That would be my educated guess based on the chart action we're seeing, and probably why OPEC is panicking with maintaining production cuts, because they fear that demand is getting weak. And, this coincides with the chart I have up. So the chart I have up here that you can see on your screens is from Crescat Capital, courtesy of Bloomberg Research, and they are a global macro hedge fund. So they noticed a very interesting trend since 1983. So it has only occurred 3 times, really, since 1983. And those 3 times, it has meant a stock market crash in the US. The S&P 500 has crashed. So this trend is between precious metal stocks and oil diverging. So gold and silver miners, precious metal miners rallying while oil prices crashed. So this is hedge fund level research, and they shared this on Twitter. So thank you to Crescat Capital for posting this on Twitter. I follow them on Twitter. Shout out to them. And I'm combining this now with some of the earnings announcements that we've gotten from some shale oil companies. Now let's talk about this. So I think there is evidence now that oil is in a very bad bear market, and things could get a lot worse before they get better. So Concho Resources, there was an interesting article that came out about the shale industry having bad earnings. It came out yesterday by Nick Cunningham at oilprice.com. Zero Hedge reposted it. It's called Oil Price Correction Triggers Shale Meltdown. So Nick Cunningham, I've been following his articles for years. They're excellent at oilprice.com. I'll attach a link in the information and description section if you want to read the full article later. But Concho Resources is an interesting company. They are a symbol on the New York Stock Exchange, CXO, Chad Xavier Oscar. So this stock used to be a darling, an absolute darling. Now they're still earning it says $2.61 per share on Yahoo Finance. I didn't look at their SEC filings. They still have a tiny dividend yield. However, if you look at the stock chart, it is telling a totally different story. So the stock price, its 52-week high was at $160.81. And the stock literally, I have a chart up now, on July 31st, the stock was still trading as high as $97.68. Well, they announced a bad earnings, and guess what? The stock has crashed down to $66.64. So in the span of less than, at most, like not even 10 days really, so July 31st to now, the stock is down from $97.68 down to $66.64. Just an enormous crash. The short-term chart looks very, very bad. It looks like it fell off a cliff. Let me look at the long-term chart. The long-term chart looks like it's in a... Yeah, the long-term chart's bad too. The long-term chart has a really bad downward sloping angle there. So the long-term chart, the max chart still... No, the max chart also looks bad. I'm doing this in real time. I didn't take a look at all the long-term charts before. So please bear with me here. So let me just summarize. I'll talk about Nick Cunningham's article a little bit. And what was said on the Concho Resources conference call. So Concho Resources, for instance, saw its share price tumble 22% when it disclosed several problems at once. Profits fell by 25% despite production increases. And this is the problem in general with shale production. So they can grow production, but it's like running on a treadmill when the speed is going faster, how you have to produce more energy. You're wearing yourself out. And that is how shale production is. You're stuck on this hamster wheel. It is not an easy oil well where you discover you spend a lot of upfront capital and you drill an oil well and you hit a gusher and it produces 50,000, 80,000, 100,000 barrels per day of oil easily for the next 40 or 50 years, and your maintenance capex is going to be fairly low. That is not how shale oil works. Shale oil, actually, the capital required, now, some investors did make a lot of money who were financing some of these shale wells early on, at least for years. They would get a quick payback period. But the longer term investors, the pension funds, the ones who are funding these equity raises for these shale oil companies and this junk bond debt, the pension funds got absolutely hosed by the shale oil companies themselves and by private equity, who was flipping them these deals for a large profit, of course, who was scalping them. So I would say the pension funds have lost probably easily $1 trillion. I don't know the exact number, but I would say the pension funds, my educated guess is the pension funds have probably lost $1 trillion or more, at least, funding shale oil. And that is so the U.S. can maintain high oil production, but this is not the type of oil production that is low capex, that is generating a lot of free cash flow, and that the shale oil producers can pay massive amounts of dividends. And they have easy oil wells that will cash flow 50,000 barrels per day for decades. This is not, now the Saudis used to have oil wells like that. The Saudis have put more work in. The Saudis are no longer producing oil at $10 a barrel. I believe the last estimate I saw had their cost closer to 30, and we're starting to rise even further. But the Saudis have been producing oil for a very, very long time. So eventually those oil wells would peak at Ghawar, and they've been bringing on, remember there was an article about a year ago that the Saudis disclosed in their Saudi Aramco IPO that the oil production at Ghawar was much lower than anyone thought, and that they had to bring on new oil wells to offset the production. So the Saudis were able to offset the production declines from Ghawar, but they had to do it with higher cost oil wells. So they had to bring on additional oil wells that were producing 1 million barrels per day. They were probably higher cost than Ghawar used to be. So continuing with Concho Resources, what they said, so in the second quarter, the company had 26 rigs in operation, but that has fallen to 18, so they're cutting back on capex. And this is the problem with shale oil. They have to constantly spend more and more capex. I believe the capex, I had seen some research reports out in the last year or so that the capex for some of these shale oil wells had ballooned to $12 billion. So I don't know if that was the initial capex, but some of the capex to maintain high levels of shale production, which was not necessarily profitable, not generating free cash flow, not paying shareholders dividends, was causing enormous explosions in capex. And in general, the oil market has high capex, but the shale oil wells, now the cost of a lot of these shale companies has come down, but these still have high capex. So the cost, the industry has delayed bankruptcy, I would say number one, by being able to raise capital, sucker pension funds, and raise capital with junk bonds and equity issuances, and also lie about production costs and reserves. And I've talked about that in the book Saudi America by Bethany McLean, who is an investigative journalist who uncovered the fraud at Enron. But the industry, even though they've lowered production costs a lot since shale started, I remember I was covering shale at Investing Daily in 2013 when that was my day job, and I was a full-time oil analyst, also covering other stocks too. And I think the production costs for shale were closer to 70. So oil was still volatile back then, and the shale costs, a lot of people didn't think that they would be able to lower costs. They have, and that has bought them some time and the ability to raise more capital. But they have just not produced any of the free cash flow or profits. There is an exception to that rule. I think EOG Resources is one of the few truly low-cost producers. They run a very tight ship, though, and they're more of an exception to the rule than the actual rule about low-cost production and maintaining better margins for shale. So the project, talking about Concho Resources, the profits fell, like I said, by 25% despite production increases. Concho conceded that it would slash spending and slow the pace of drilling in the second half of the year. And this is because they can't afford it. The capex bill is too high, and they didn't generate the margins and the free cash flow that they were expecting. So it is also said that one of the projects where it tried to densely pack wells together, which it called, quote, Dominator, the results were not as good as they had hoped. The project had 23 wells, but production disappointed. The 30 and 60-day production rates were consistent with our other projects in that area, but their performance has declined. And that's another thing about these shale wells is within about 3 years, I think the production levels at the shale wells has declined by more than 75%. So you're pulling all the production forward from these wells. So these wells peak very, very quickly. They peak within about 3 or 4 years. And then there's enormous drop-offs. Actually, I think they peak within a year. And the drop-offs are down to more than 75% within about 3 years. So if you're a long-term investor in shale, you're going to lose. That's how I would view things, at least. Again, this is not financial advice. So if you're looking for, this is not financial advice. If you're looking for shorting opportunities, some of these shale producers look pretty ripe. The company is still hoping for free cash flow in 2020. It doesn't sound like it's going to get it, though. So Concho reported a net loss of $792 million for the first 6 months of 2019. And then this is a Bloomberg op-ed, another article quoting that. It is sobering to think that Concho, Liam Denning wrote this piece, it's quoted, quote, "It's sobering to think that Concho, valued at more than $23 billion in the spring of 2018, and having since absorbed the $7.6 billion purchase of RSP Permian Inc., now sports a market cap of less than $16 billion, end quote. The reason these results are important is because they may not be one-off problems for individual companies, but are more likely indicative of the problems plaguing the whole sector." So, quote, "There is little doubt this is a big event for the sector, and a break of this nature will create lasting impact," end quote. Evercore analyst Stephen Richardson wrote in a note referring to Concho's poor results, quote, "How companies still, after all these years, we have wailed and gnashed our teeth, managed to overpromise and underdeliver remains an infuriating mystery," end quote. So this is just more proof that shale has never, other than EOG Resources, and maybe short quarters here or there where there is profits and free cash flow, shale has never lived up to the promise. Okay, the financial results are not there. Now, if you have made money being long shale stocks, congratulations. But if you are a buy and hold investor in this stuff, it sounds way too risky for me. If I was managing money and trading these shale stocks, I would probably not be long a lot of these things. Some of these guys may end up getting bought at lower than expected valuations by the oil majors like ExxonMobil and Royal Dutch Shell and Chevron and those guys. I don't think the buyout premiums, if there are buyout premiums, are going to be very large. But it's looking like the shale oil, unless the oil price has a sudden rally and the oil chart doesn't look good, and I just talked about this divergence, which, by the way, this divergence also, the other times the divergence happened, and you can see in the chart, it was in 2000 between precious metal stocks and the oil price was between 1999 and 2000 and 2008, 2009. And we just had it again in May, where precious metal stocks went on a big rally and the oil price started diving. So it's not looking good for the S&P 500 either if this indicator holds true. It may or may not, but this is an interesting piece of research, I think, by Crescat Capital. The stock charts, though, for Concho Resources not looking good. This is not financial advice, just my opinion. If the stock were to, say, crash another 50% or 60%, I think the management team of that Concho would be calling up some of the oil majors looking to get out for a buyout, worried that things could get a lot worse. But at that point, you don't know what premium you're going to get on a buyout. So if you're managing money, and again, this is not financial advice, I think the way to play this might be with options, trading that volatility. This stock looks like it's going to be extremely volatile. We could have easily $10 or $20 per share movements in the stock price in a month or every month or two. Easily. And a lot of these shale oil companies have bad balance sheets. These are not companies that are continuously raising capital, that are debt-free and using equity. A lot of these companies have way too much junk bond debt that will probably either have to be refinanced or be defaulted on. And there's a massive amount of junk bond debt. I think there's over $3 trillion, a record now, in total junk bond debt in the United States, and a very large chunk of it is U.S. shale oil producer debt. So the U.S. has a lot of oil production. You have these stupid politicians. I don't think Democrats are doing this right now, but you have Republican politicians, including Trump, saying that the U.S. is energy independent. Well, that oil is not really economic. It's been subsidized by pension funds and mutual funds and the Federal Reserve that have subsidized cheap credit, and then suckers bought the equity. They may have made some money in the short term, but in the long term, it looks like long-term investors in these shale oil companies are going to be totally screwed. Now, if you got in on shale in 2007 and you rode the boom up, you did well, but longer term, if you've been buying it for the last 5 or 6 years, you're probably risking a big bust. So comment about what you think about shale and what you think about that chart there from Crescat Capital, which is a hedge fund, about the big divergence between precious metal stocks and oil prices, and if you think oil is in a bear market and what you think it could mean for the S&P 500. It's an interesting correlation there, and big divergence between gold and oil. Okay, well, that's it for right now. Hopefully you guys have had a chance to watch my China video. I put it out late last night. Unfortunately, I think I haven't gotten that much in tips yet, but hopefully I'll get more Patreon contributors soon. I did put in a lot of work there. Normally, like chief investment officers do that type of research work, and that's for, full-time job, and that's for their clients only. Occasionally, they'll put a slide deck out like that on Macro Voices, but normally that type of stuff is not given out for free. Okay, guys, I'll talk to you later.